So I want to go through how I look at the bonds, guys. So I've just pulled this up. And again, this is just, bond edge. Uh, I went back to like April 1st. And when I'm doing this analysis, the reason that I went to April 1st is like, it's when it really first settled down. So if I go back further, we're going to get all that garbage from when the VIX spiked in March, which kind of makes the data really just difficult to look at. So what I was trying to do is grab enough data that I can without that kind of crazy volatility that we had back in March. So for me, just leaving these things up throughout the day, I'm leaving up, starting at April 1st. Starting April 1st gives me, about a little bit more than 2 months. So again, that's what I was looking to do in analyzing these spreads. If I went further back, I just felt like the data was crappy. So I keep playing around with it until I could just get a visual that I'm comfortable with. And to me, this is a nice visual. Okay, I can see kind of the rubber band pushing and pulling off one another. This is something that I can work with. And this would be the first step. After that, I'm going to dig deeper into this trade, but I just want to show I'm not starting like 2 years back. Okay, I just want to, and I guess I'm not starting 2 years back because this isn't really like a structural long-term trade that I'm looking for. I'm just looking for opportunity. I'm just looking for, right now, bonds are moving. What spreads are strong? What spreads are weak? What contracts are strong? What contracts are weak? And by doing this, going back to April 1st, I feel like I get a better sense for that. So does that make sense, guys, why I'm using this time frame? And then I'll drill into the individual spreads that I'm using. Good, good, good. Okay. And do you feel that like sometimes you open up one of these edge series and you look at 2 years of data and it's like, what are you going to do with this? Like there's just too much or there's just too much noise. So you always want to figure out whatever time frame that you're trading, you want to analyze the market in the same time frame. So right now, looking for a trade that would be anywhere from like an hour to 2 weeks out, I'm comfortable with this time frame. And so what I'll do now is I'm just going to open it up because I already know that we're starting April 1st. I'm comfortable with that. And now I really just want to drill in and see, okay, what's wrong? And what was wrong that, we just had ZNTN, right? Looking back on it now, can you guys see, just clear as day that this blue line was inexpensive relative to the yield curve, without a doubt. I consider that like just a really, really easy, kind of straightforward trade where we just knew this was wrong. Now what's interesting is all the spreads that we're looking at here are going to be back end of the curve, right? The only thing that dips into the middle of the curve is going to be that FOB, this purple line, but everything else is TN, ZN, ZB. We're looking at the back end of the yield curve. And so when we're doing this, now I want to kind of see which spreads are really, really correlated, which spreads are really pushing and pulling off one another. Right away, looking at, the NTN and the BUB obviously are very, very close. I'm going to take off the FOB because I don't think the FOB is really, adding to the story. Actually, let me ask you guys, what is the story? What's going on right now with the yield curve? So if I just kind of called you on the phone and said, real quickly, give me a one line, what's going on with the yield curve? What would you say? What's going on with the yield curve today? Good. Everyone who answered got it right. What's going on with the yield curve today? Do your best, guys. Throw it out there. Throw a guess out there. There you go, Adam. Awesome. Atta boy. Everyone who tried's got it right. So what's going on today is the yield curve is getting steeper. The yield curve is getting steeper. So when the yield curve gets steeper, there's a bigger difference between short-term rates and longer-term rates. So you could say 2-year against 30-year. You could look at those two, and if it rallies, they're getting steeper. And what that means is the 2-year yield and the 30-year yield have a bigger difference between them. Or we can look at something as small as the 5-year and 10-year. 5 years against 10 years, or really 4-year against 7-year. So the idea is, if the entire yield curve is steepening, we would then say, you know what, if the entire yield curve is steepening, it's probably fair to assume that the entire yield curve is steepening, that everything is steepening within the yield curve. So if there are these individual points within the yield curve that aren't necessarily moving in the same direction, those could present opportunity. And so if we look here versus here, the yield curve was steepening, right? But the one thing that wasn't steepening was the trade that we shared on the spreadsheet, the trade that we've been talking about for a while, because there was a clear disconnect. Okay? And so now that's really what I'm always looking to do. I'm always trying to figure out, where is the breakdown? Who's not playing well with others? So now what I want to do is I want to simplify the analysis to just try to show a clearer picture. And the clearer picture I'm going to start with is the fob. I'm going to take out the fob because the fob's not telling me anything that the null is not telling me. I'm already getting the information from the purple line, and I'm getting that from the white line, and therefore I can remove the duration risk between ZF and TN.